When you reach retirement, you've got to have your retirement war chest in place. Now, what do I mean by retirement war chest? That's just a term that we use here in the financial industry to refer to a bucket of money that is safe and secure and will cover your first 3 years of retirement. And to be conservative, it could cover even 4 years or 5 years. It could cover a longer number of years if you want to be more conservative. But 3 years would be the minimum number of years that you would want your retirement war chest to cover, and you want it in place at retirement. That means you have to do some planning ahead of time in order to have it in place when you hit retirement. Now, I see a lot of people over the years, I've helped a lot of people, and I see people hit retirement and encounter some issues. And so I want to talk to you about these issues. You know, if you're somebody that owns a lot of real estate is a very good investment. It provides excellent income, rental income from the real estate, but it doesn't necessarily stay rented all the time. There can be issues that happen in the real estate market. And so if you've got most of your wealth tied up in real estate and you have very little in the way of cash in the bank or other safe, secure accounts, then you could be at risk in that early part of your retirement. So you want to think about how you can build a retirement war chest to have on hand in addition to the rent coming in from real estate. If you're somebody that has saved very well in all of your tax-deferred accounts over the years, that's what you've been told to do, that's what you've done, you've just put the money in there without a whole lot of thought about it. It's been great because it's grown and you haven't had to pay tax on those accounts, you've gotten that tax deduction. Well, when you hit retirement, you're going to have less liquidity than somebody that has built their retirement war chest. Every time you need to take money from your accounts to cover your expenses, it's going to create income tax. And the more money you have to take, then the more income tax you're going to be paying because it's going to push you up into higher and higher income tax brackets. What you want to do is pre-plan so that you have money in a war chest, retirement war chest, that can cover that cash flow and help minimize the tax cost over those early years. And then if you're somebody that has saved very well outside of your retirement plans, maybe you didn't really have access to a lot of retirement plans, or maybe you saved over and above that, and you've got accounts where you invested a long time ago. Maybe you bought Amazon when it first came out, or you bought other stocks many, many years ago, and those stocks have grown, the dividends have reinvested over time, they've accumulated, and now you're looking at a big, big gain on any stock that you sell. Again, that creates some issue with how much do you sell each year in retirement? What tax does that create? What bracket does that push you up into? And if you don't do some pre-planning, then it puts you in a box tax-wise. You don't have a lot of choice. And so that can create some issues for you if you don't pre-plan and get your war chest built beforehand. What I recommend is that 5 years before retirement, you begin to build your war chest. You think about what money do you have? What money can go into the right kind of accounts that are liquid, safe, secure, and going to be accessible when you retire to help cover the first 3, 4, 5 years of retirement income. You could redirect dividends, you could redirect savings, you could redirect rent income, you could redirect monies that you're receiving now while you're still working and begin to build up this war chest so that when you hit retirement, you have the war chest in place. Now, if you need some help with that, thinking through that, reach out. I'll be happy to answer some questions or schedule a planning meeting if that's something that you'd like to have. And with that, I hope that helps you be on your best path in your retirement. You want to make sure that you're safe and secure in that the first years of retirement that you're not having to dip into anything, at the wrong or inappropriate time or pay way too much tax. So you want to make sure that you are on your best path at the beginning of retirement and all the way through retirement.